to share? Yeah, yeah. Okay. So you can see the uh, full screen, right? It's not the PPT editing mode or so. So yeah. Okay, fine then. Um, Now let's get into the, or probably I'll just give a brief introduction of myself as to what I've been.
Dr. Deepak
Doing.
started recording.
Yeah, yeah, yeah. You can
Recording.
start. Okay, good. Thanks for reminding and recording also, because some people are asking for this. Okay, so I'm Chaitanya and I have been mostly an investor, a trader, as well as a portfolio hedger. I have traded in cash markets as well as F&O since I can say since 2007. I've been investing in multiple instruments and have traded also in quite some instruments, and I learned a lot of lessons. Have lost money, have won a lot. All those things that maybe I can tell right now. But mostly, I have learned a lot of things over the last 18 years or so of my investing and trading journey. So maybe quickly, 2 minutes I will just take to say what all I did. So in 2007 is when I started with basic ULIPs and some mutual funds as such, which was not too big. It was very small, but I just continued that SIP, which went on, and thanks my when my father also continued investing in other stocks or so later on, maybe from 2012 or so. So we had a good investing journey overall for quite some time, and at least I could see the compounding effect in the investing journey bear the fruit at least in the last 2 or 3 years. So that old investments, whatever we had done, slowly grew bigger and bigger, and it was not. Maybe I must say a lot of it is also luck. Mostly I should have gone with index funds or so, but in the beginning I was mostly doing let's say only some mutual funds and some other things, but then some stocks also. My dad had some PSU based dividend stocks and things like this, which actually gave really good returns, almost 10x or even more. This was some luck, but overall, if I had even gone with index funds, the returns would have been similar. That's what I would say. Okay, now coming to the trading parts, it was less. Mostly, whatever I did was during 2007 to 11, a few things here and there, which I was doing in cash markets, and later on in F&O. For the last 7 years, I've been trading, but then off late, in the last 2 or 3 years, the F&O part is mostly to hedge my portfolio. So this is what I'm doing. So in case market falls, let's say 50% or 70%, my portfolio should not fall more than 15-20%. So that's the main point behind this. So let's say I had a portfolio of 1 crore or 10 crores. Okay. So then if market falls 50%, it should not become 5 crores. Okay. So the portfolio will only become, let's say, um, 8 crores or so in case of a drastic market fall, 50 or even 80% for that matter. So this is the main objective of portfolio hedging. So maybe I will first start with long-term investing. This is the first part. So this is the maybe the introduction is what is the essence of long-term investing and how we go about it. So there will be two parts. First part is long-term investing. Second part is portfolio hedging, and then how we can hedge our portfolio and different ways on how we could achieve that. Right. So this is what I'm looking at. So long-term, when it comes to long-term investing, it's mostly about how can we sustain in the long run for the, let's say, how long would we be able to invest, and then what is the benefit, compounding benefit, snowballing effect, all these things we'll go through. Okay, so right now at least, what is the importance, what are the benefits, and then what are the strategies. Okay, so all these things we will try to explore right now for the long-term investing part. Okay, so now let me move on to the next slide. So even before that, let me give a disclaimer or so, saying that this is not a end-to-end, let's say this is not end-to-end webinar or so where I'm trying to explain everything, but I'm only touching upon the basics at a high level, so that the basic, whoever is at basic level and then intermediate level should be able to understand also. But I'm not going or having a deep dive into individual strategies. Maybe that we could have another day or some other time whenever we feel it is feasible. But right now I feel it is too much to cover all these things within one session, right? So yeah, so maybe let me start off then. So what is long-term investing, and maybe let me introduce long-term investing. At least we have been talking in WhatsApp groups or so, to say what is long-term investing, and then what should we do, how we should change everything. So this is mostly about the psychology, right? So we have to change our psychology, all these points, map to that psychology to
either.
hello, yeah, okay. So maybe some crosstalk. Okay, so it is mostly about the psychology that we need to develop on how and what. So there have been quotes by a
Your
lot of
friend
people.
Karthik has come apparently to Arham's place. You want to go?
Hello,
Do you know about it?
I think maybe you need to mute others.
I have muted, sir.
Okay, yeah, sure. So the main thing here is investing. When we say investing, it should not be like, I know there are a lot of people who ask me, or maybe even others in multiple groups where we have seen that, can I invest this for, let's say, next 2 years? Can I invest on this stock? Let's say, what do you see the outcome? What is the outcome for this stock or so in the next 6 months, 2 years? They consider all these things as investing. Okay, so for me, that is not investing. That is called as trading. Directly, I can just tell you that it is trading, and then a lot of things depends on our luck. There's a luck factor which is there, because people, when they invest and they make money, right? Let's say for a, or when they trade, in this case, maybe it could be like 2 years, 3 years, whatever it is. When they make money, they consider that it is their investments which got them, and then maybe it is their, let's say, they give a lot of importance for their skills and things like that. Of course, I don't deny the fact that there might be some people who are doing it, and then maybe they can beat the markets, or so they have some kind of alpha or edge where they'll be able to beat the markets. But in general, when I talk about it, it is extremely difficult to beat the markets. And even if we go by the back testing, right? So, and then when we try to mimic the same thing and then have play strategies to mimic this, so definitely it's not easy to achieve the same results, because past is not, we can't repeat the past, right? So the whatever past performance, it doesn't guarantee future returns. So that's what all these people say. So when it comes to investing, so we'll always need to consider for a minimum period of 7 to 10 years. I have put it 10 years here in this because it is better to record that, I mean, in our mind, that it is 10 plus years. When I want to invest something, it should be for long term, preferably in index funds. I would say index funds, because that is the kind of the safest, and I don't need to do any hand picking. If it is some stock, we'll need to do fundamental analysis. I agree that some people can do it, but still we'll need to keep churning, and then a lot of things, our emotions come into picture. So wherever possible, we'll need to try to avoid our emotions whenever it is there. So that is what is the same. That is what I would want to say. But of course, if there is some itch or so, some small thing where I need to take it, I want to take some kind of stock or something, maybe it is okay. Maybe 1% of your portfolio, 2%, something like that. You can still do maybe individual stocks, so that it will also ensure that you're not, it's like eating junk food, right? So when I say I want to eat junk food, I would say I will go on diet, strict diet, but then one day, someday or so, I want to skip, or it should be a free day, right? Cheat day is what we call it. So like that, if you consider that like that, maybe 1 or 2 stocks here and there for your own satisfaction, it is still okay, I would say. I mean, I don't recommend that for everyone, but myself and then maybe even a few others can do it, because it's not a big hit where it takes. But generally, I would say 80% of our portfolio should be in index funds. Okay, I mean, for me, when I talk about myself, but if someone is really good at, let's say, fundamentals or so, then they can still try out the stock picking as such, top stocks, very good stocks and things like that. So now when it comes to fund managers, right, the mutual funds, all the active mutual funds where there is some high expense ratios, all such things, the history says that 95% of the fund managers in the long period, let's say 20 year, 30-year period, we can hardly count some 4 or 5 fund managers who have beaten index, right? So it's extremely difficult to beat index, and this is what even people now are struggling. Okay, maybe index has gone down a little bit right now, but if you see the long term, that's what it says. Of course, I'm not predicting. Again, I'm not taking the past and then I'm not saying that in future it will not be. It will be that index will always beat other funds, but even if you are picking some other fund, what fund will it be, on what basis? Or so if you have a strong conviction or so, then maybe it might be worth a try. But for most of the people, it makes sense that we go with index, right? So when it comes to trading, 99% of the traders fail. Even to beat the FD returns, they struggle. Okay, so this is a big challenge wherein the trading aspect also has to be taken care of, right? Okay, so what are the benefits of long-term investment? So here, when I compare it to trading or any other thing, right? Even portfolio churning for stocks, so that still costs us 12% or whatever. That is okay. But then if we keep churning, right? So we are just trying to time the markets, and then it's difficult. But when it comes to trading and other things, the problem is short-term capital gains. Every time if I make some percentage, you will have to subtract the short-term capital gains, and the final percentage would be much lesser. Let's say I made 30% in a year, but then if there are 5 trades, in each time I would have lost to 2% or so. I mean, let's say 8% I did, I would have got actually 6% or something, because that capital gains has gone. Similarly, I would have got some 10% another time, it would have been only 8%. Like that, if we keep adding, so or subtracting that percentage, STCG, so a lot is lost there only, right? So maybe it might not be 30%, it might be 20% or so, or even 18%. And then it's not, 30% is not easy at all. Maybe if someone is getting 15 to 18% in their trading strategies, they are really good. They are God actually. So even we talk about the best traders, maybe Jim Simons is an exception who has got some 65 plus, but most of them, best fund managers and all those guys, are getting at around 15 to 20% range, which is really good. And it is extremely, I tell you what, it's extremely difficult to get that as well. Okay, so time in the market is more important than timing the market. This is what the quote goes, right? So this is very important, right? And yeah, so tax advantages are there for long-term investing. I don't need to invest, so so I don't need to pay taxes for 1.25 lakhs, and even higher ones, it's only 12.5% if I want to exit that also. And there are other sections also, like section 54F if someone is planning to buy a house, which again I won't recommend to go to real estate side. But then if there is something or some way where if someone has to live, right? So if he is buying his own house or so, in some case, then this could be one way to save taxes. And the other thing is, in general, 12.5% is very less compared to 30%. It will not impede our compounding effect. So this is what I would want to say here. So let's move on to the next slide. So here I will talk about the snowballing effect. So all these things, whatever I'm talking, is to build the psychology. Psychology is more important than anything else here, right? So this is what we need to focus on, how and why we should focus on the long-term investing. Maybe some people can do still some trading to a certain extent with a very small percentage of their portfolio. So that will keep them busy. Also, that will give them something to work with, saying that if they have got profits also, they will be happy that I did something also. But generally, they can do only if they have some additional time also. But generally, most of us are in our professions fully busy. So trading doesn't make sense at all in that case. So for most of the people, again, I'm not saying that trading is wrong, all such things. For 99% of the people, it doesn't make sense. It is better off in investing and investing in index funds. We can blindly invest and just keep on ensuring that the money is, so our returns, the investments beats inflation by 2 to 3%. If that is there, then that is good enough, right? So more than good enough. So inflation is 5%, and let's say the lifestyle inflation, wherein we upgrade our things, is another 2%. Let's say overall inflation is 7 to 8% or so. Government inflation is 5%. Lifestyle inflation is another 2 to 3%. That's 7 to 8%. And if our returns from our overall portfolio, diversified portfolio, is 10%, this is, what else can we ask for? This is more than enough. But people aim for 15%, 20%, or 25% also. It is not that way. We will never be able to achieve that consistently. We can see the examples of mid cap and small cap funds also. Definitely, there has been returns in mid cap, let's say mid and small cap, about 20% for the last many years. But this year, if you see already, it has fallen down so much, and there's no guarantee that we will be able to get 20. But that's why we have to be grounded, keep our expectations low to 10% or so, and then move on. And that is good enough. 2 to 3% returns extra on top of our lifestyle inflation for a decade or two is pure gold. It is gold. There's nothing else is better than that. We will be in one of the, if we are investing good enough, let's say at least 50% of our salary there, then at least we will be in the one of the wealthiest persons when we talk about a 20-year time frame, right? Okay, now coming to the snowballing effect. So what is snowballing effect? So here we start off with our SIPs slowly. So there will be an initial momentum which is there. So consistent investment where it will be very small. We will not even notice, right? So why does Charlie Munger always say the first 100K is a? So this is his classic dialogue. What he says. It's extremely difficult to get the first 100K. Once you get the first 100K, then the snowballing effect kicks in, and then on it gets very easy. So we can just take off the pedal from the accelerator, and we can just cool down, right? So we can step off of the gas pedal and then just cool down, and then it will automatically grow. So even if you're talking about 10%, 10 to 12%, so the 100K, that means maybe let's say 80 lakhs, or let's talk about 1 crore in Indian terms because we are all Indians here. So 1 crore INR, if you have that. So in Indian terms, every year it is growing by 10 lakhs, right? So someone would have invested 1 lakh also, someone might have invested even 1,000 also. Everyone is making similar returns in index. But the guy who has 1 crore, his job is very easy, right? He doesn't need to do anything at all. It will keep increasing by 10 lakhs. So when I talk about fire, right? So I'm also into the fire journey. So if we have 10 crores, for example, in Indian context, if we are getting 1 crore, if our portfolio is growing by 1 crore every year in passive way, what else is needed? So this is what we'll need to focus on. The psychology should be such that we are not looking at shorter term falls. So even now market has fallen. So these are the times. So let me put it this way. These are the times not to stop our SIPs. This is the worst time to stop our SIPs, because there will be a lot of people thinking, should I stop my SIP? Market has fallen so much. So this is where the snowballing effect will actually take some extra acceleration. Okay, once this time is over, right? So this bear phase or whatever, the short-term corrections, maybe it can correct more. I don't want to predict anything. In the long run, at least the idea is it will have to beat inflation by 2 to 3%, right? So that is the general consensus that we are seeing. So let me come to it. I will also tell that equity is not the only thing. Maybe I am doing, at least this is my style. I will do it in 2 or 3 other things. So to hedge my portfolio, but let's see overall if our portfolio is growing at 2 to 3% higher than the lifestyle inflation, that is more than enough. So once the snowball starts rolling, it gathers mass, and then it keeps growing and growing and growing. Once it rolls down the hill, when it comes almost to the bottom of the hill, the snowball would be so big that it would have accumulated so much mass, right? So this is the most important thing. And for this, patience and discipline is the most important thing. And also giving the time, right? So this is where the accelerated growth is, what the exponential growth is what we see. And human mind is tuned such that we are not able to assess the exponential growth. We are only tuned to understand linear growth, right? Exponential is extremely difficult. So this is what I would say. So am I audible? And then any questions so far?
Audible,
Okay,
sir.
okay, thank you.
So when you refer to index, what is the index you're referring to? Because now every ETF, every fund house is coming up with loads of index. Every
Yes, yes,
retail funds
yes,
have the term index, and investors
yes,
are too confused about it.
yes, yes. So I would say it is better to stick with Nifty 50 index fund. That's the only thing. If at all we are like even maybe uh, if you're interested in other index funds, maybe very small portion we could still do. But again, the maintenance of it, all such things, we have to be ready with it also. Um, or just blindly invest in few other maybe momentum alpha funds, very small portion. I would still say the bulk of it should go to Nifty 50 index funds as much as possible, 70% or so. So this is what I would say. Yeah. Um, Coming to the active part also, so here in active investment, there are some fund managers and other things, for example, where they say that uh, uh, their psychology, right? If you fall in love with their psychology and then their mindset, and if it is matching your mindset, then also it's okay to a certain extent to invest in their funds. But still, having said all of these, now let me come back to my original point. Even for the index, other index funds, maybe small cap, mid cap, all these things, I would say Nifty 50 index fund should be like bulk 60 to 70%, no matter what. Even after you invest in other places, maybe small things, I would say Nifty 50 index fund should be maybe mostly 60 to 70 percent of your portfolio. Okay, so this is what it is. This is what we'll need to plan for. Yeah. Okay. Coming to the next slide. Uh, So diversification. When I already said we will need to diversify, and then I said I will explain what is diversification, right? So it's better not to put all our eggs in one basket, right? So it's better to put elsewhere also, some parts of it in stocks, some in bonds, some in gold, etc., etc. So far what I was talking is 60 to 70% of my equity portfolio should be in index funds, right? So I was talking about equity only, equity part of that. So if I say equity is 100%, now if I take the overall portfolio, okay, in the overall portfolio, I would say maybe equity can be 70% and remaining 60 to 70% can be equity, 30 to 40% can be stocks, bonds, gold, and other instruments like even FDs are also to a certain extent okay. It depends totally on what is our income and things like that. Okay, so if we don't have any other income, then FDs are good because we have now 12 lakhs right rebate after the new taxation rule. So this is good enough. So we can do a mix of all. So what I would say is maybe spreading the investments across different asset classes. Okay, stocks, bonds, gold. So what does this mean? So it so we will have, in case market falls heavily, so we have one more level of cushion here, so that our stock or overall portfolio will not fall much. So this 70%, if there is a 50% crash, equity will become 70% to 35%, let's say, and then bonds and gold might be the same or more, right? The other 30%. So overall, our portfolio would still be 65 to 70% of what we have. So now this is one part of it. The other part I was telling, portfolio hedging with F&O options, right? So if we do that, then maybe our overall portfolio might still be 75% or 85% of whatever our current, even with a 50% fall in markets, right? So that way we won't see a big impact if we plan it correctly. So then we don't see big impacts overall at all from any of our in any of our investments, right? This is why I say it is okay if we don't need to get 15%, even if we get 10 to 12% over the long term, that is gold dust, is what I would say. So this is why we need to diversify our portfolio across various places. So now there are multiple strategies. There are several strategies: dollar cost averaging, value investing, and growth investing. Okay. So some people do growth investing. So this is what I was telling. So there will be growth funds also, right? So for people who are familiar with Vanguard funds, so in US market, at least I have been investing in some growth funds as well, and then index funds also. So in this case, I want to have a balance there. So I do VUG, VOOG, and things like that. Of course, I also do dividend funds. Dividend funds are very conservative, but the point is, I also pay taxes for the dividends, right? So definitely I'll have to pay taxes. So, but the point is, in case market falls, there is a 50% crash or 70% crash, still we will be able to, we will be getting some sort of monthly income, right? So this is the point. So where this helps our psychology. Maybe it might not be tax friendly, it might not be really good, and so on. But then, if we are getting a consistent income, let's say I was getting let's say 1 lakh rupees per month earlier. Now, if I'm getting 50,000 rupees, still something is better than nothing, right? So there is some income that is flowing in. So I want to have a mix of dividend funds, a mix of maybe growth funds, a mix of maybe dollar cost averaging on just index funds, pure index fund, Nifty 50 index fund. This is what I was telling. So all these things I can do a mix of, and then we can try to achieve this 10% returns or across whatever I was telling, right? 10 to 12%. So no matter what, if you're investing here, so when I say in Nifty 50 index funds, we are betting on the top 50 businesses of India, right? So top 50 business families in India. So these top 50 have some leverage. They also have lobbying power also in general. So I'm not telling the government is wrong or anything here. I don't want to go into politics as well, but in any country, if you see that there is always lobbying power, and and the top businesses always will be making more better profits, right? So because they have that additional support from the government, even in case something happens. That subtle thing which we might not notice, or maybe some people noticing also, they have that advantage also, that additional thing. So top 50 businesses are always there, and no matter what happens to some business, if it goes down, there will be some other business coming up there. For example, Yes Bank was there in Nifty 50 index, it went off. Like that, we have multiple examples recently also. Some things went out and then some things came back. So definitely we are at least having some good amount of, I would say, good stocks, and then we don't need to monitor at all. It is automatically monitored or added or subtracted from the index. This is the main advantage why I would say index, Nifty 50 index would make a lot of sense there. And for if you want to invest a little bit in mid cap and small cap, that 15% is what I was telling. So there you could still again go with mid cap 50, mid cap 150 also. Similarly, we have small cap 50, small cap 250 kind of index funds, right? So this is what we can look to invest our money. Now let me come to portfolio hedging. This is the second part of my session. So, okay, sorry, before going here, so this diversification itself, what is the diversification? What is the percentage? How much? I just touched upon it quickly at a very short span, and then this, I didn't want to take too much of the time because this itself can be a very big session. Okay, each of these can be a very big session, and maybe other people or myself, if we find time, we can take it later on, some other week or so. At least I would say we would cover it separately one by one. If I cover all these things in one session, it is too much for people who are at least in basic mode. Okay, so let me go on to the next session, next part of this session. So portfolio hedging. What is portfolio hedging? Yeah. So there are hedging techniques which are defined and then which ensure that no matter what happens to the overall market, our portfolio stays intact. So this is what I was telling earlier also. We can ensure that even if market falls 50% or 70%, our overall portfolio will hardly fall 15%, right? So this is what is the most important thing that we'll need to focus on after one point. So there are two things. One is capital appreciation, and second is capital preservation. Okay, for capital appreciation, people want to make quick money, and then they want to trade and then ensure that they might have 1 lakh or 10 lakhs. They want to make it 1 crore soon. Okay, so their main aim would be that let me trade in some mid cap, small cap funds. Let me do some intraday trading. Let me do some F&O trading, and let me make it 10x within 1 year or 2 years. This is not possible at all. This is extremely difficult, and only maybe a lucky few people would be able to grow their capital this way. What I would say is focus on increasing your salary, whatever you're doing, your niche skill, or so, increasing that salary, or maybe saving more money, investing more money into the markets, right? So that is what helps. Don't take debt, don't take loans on unnecessary things, don't take loan on, let's say, depreciating assets. Having said that, I don't want you to be extremely frugal where you don't live your life. So you have to have some sort of a balance. Live your life, have that luxury at least, so that you feel happy. You should not be tied up with everything. But I would say invest most of your corpus into the long-term assets. And as I was telling, once the snowballing effect takes place, within 5 to 7 years, you will start noticing already the huge amount of portfolio move which will be there because of your accumulation, right? So the accumulation phase is very important. It will take time, and there is no other shortcut. Okay, that is the most guaranteed way. 5 to 7 years or 10 years, if you are investing, that is the most guaranteed way where you will be able to see the actual compounding. Even I haven't done that. I mean, I have done 18 years of investment, but then I was not increasing my investment. This is what I learned later on. Maybe by 2017, 18 or so, that is when I learned. It was very small, and then it was not increasing. So now step up SIP is also a very important point here. What I want to say, I didn't cover it in the PPTs, but then that is very important where we need to step up our SIPs as such. At every month or so, or every year, I would say 10%, increase your SIPs by 10%, then that helps a lot. Okay, so hedging. What is hedging? Hedging is a strategy used to reduce or manage risk by taking a position in a security that offsets potential losses or gains in another investment. Okay, so it reduces risk, it protects our investments, and most important thing, right? We can improve sleep at night. So we will be stress free, or else we'll be stressed out. Okay, let's say, what is happening to my trade, my F&O trade? If I am taking a bet, what do I do with this XYZ trade, XYZ overnight? What is happening? What is Trump doing? What is Trump tweeting or doing? So all these worries would be there. Why should we add additional stress? Already we have a lot of stress in our daily jobs. I don't find it meaningful to have add one more level of stress here, which again affects our health. So health and wealth, these two are the most important things we need to focus on. So for this, the most important thing is hedging the portfolio. Hedging the portfolio can be done once it crosses a certain amount. Let's say if it crosses 50 lakhs or 80 lakhs, when you think that if there's a 50% crash, and is it okay to sustain that also? Is it okay for you to think about, let's say for a 80 lakh portfolio to lose 40 lakhs? Is it okay? For a 50 lakh portfolio to lose 25 lakhs, is that okay? So if you feel it is okay, then you can still not hedge until you feel it is pretty big, let's say 1 crore or 2 crores or so. But then beyond 1 crore, I would say it's still good to start hedging the portfolio and then ensuring that things are giving returns, right? So there are multiple ways to hedge the portfolio. Each of these ways, I would tell you, can be a big session, right? So it can be 1 hour sessions for each of these. I didn't want to touch upon too much because today's session itself is 1 hour, and then it will become, I would be really boring here if I start talking about it. So it would be extremely boring. So let me talk the most important things, and then I will also touch upon the derivatives part, how we will do for F&O also. Yeah, maybe what I'm doing and then things like that. I had planned to at least show the portfolio also from my side, let's say the percentage allocation and then how it grew, but somehow I couldn't do it. I felt that these things itself will cover a lot, so it's extremely difficult to cover in this session, at least. So at least I would say diversification, right? So what we talked about sometime back in the earlier investing part. So stocks, bonds, all those things. If we diversify, that itself is a hedge. As I was telling the 70% example, when you have 70% in equity and maybe 15% in let's say bonds and another 15% in gold. If market falls 50%, your portfolio will fall only 30%. This itself is one kind of hedge. Okay. Next is derivatives. So derivatives is where I buy a put option, or maybe I do some covered calls for. These are a little complex concepts for people who are new into this F&O space. but those who know maybe might understand what is covered call and then buying a put option. So basically, we are betting that market will go down and then ensure still we will earn some money in the sidelines, right? So this is what is called covered call and then buying a put. The other one is inverse ETFs. So actually, this is coming in Indian market also. This was in US market so far, but then as per that new instrument that is being proposed, so there is a draft which is ongoing, and then soon it will be coming. This is what SEBI was telling. So that new instrument at least will be able to help us with something similar to inverse ETFs, where I think the ticket size is 10 lakhs or so, but we could still think about this, right? So alternative investments, again, okay, I think this a little bit clashes with the or overlaps with the first point. Here also, it's more like diversified. Cryptocurrencies, I don't actually maybe endorse that, but to a certain extent, I have been also investing. Long back, I just invested it. I treat it as a long-term call option with no expiry date, right? It just keeps running. It's like a small investment which I did, some 1% of my portfolio, overall portfolio, and I just don't care about it and leave it as is. And I won't endorse it also. I don't have any fundamental, let's say, backing also, where I would say that cryptos are really good and things like that. But then I'll just put it as a point, right? Because I was doing it and I have not touched it so far. And usage of bullish, there is something called grid bot. This came from the crypto concept only, but then it can be done in equity also. Here the concept is if market stays stagnant for a quite amount of time, right? So let's say if it falls. So I will give a basic example of a grid bot. Okay. So as I said, each of these points itself can need a separate session of 30 minutes or 1 hour. But now I'll just touch upon the basics here. When I say grid bot, let's say Nifty falls 5%, then I buy X amount of stock, Nifty Bs, let's say. If it falls another 5% from there, I'll buy another X%. Another 5% fall, another X%, so on and so forth. I'll keep buying some X amount of money. Let's say I will invest 1 lakh money at every 5% fall, okay? And my point is to exit as soon as I get from my investment, whatever is there. If I get, let's say 10% returns, whatever from the invested place, if I get 10% returns, then I will exit, okay? So this is some rule which I'm telling. So this is kind of a way. So if I follow this rule, okay, if market keeps oscillating and doesn't move anywhere at all, if it is too stagnant, if it keeps oscillating, let's say for years together, then this strategy will make good money. Again, this can be trading also, what I told you. It can be STCG also if the market is oscillating very fast. So again, this might not make really sense, a big and even in terms of returns, it might not make sense. But here the point what I'm trying to make is this is a blind investing kind of thing, and then blind churning of the markets. So if market stays stagnant, this means that I can still make some sort of money no matter what happens, right? So this is the main essence of this. If market stays stagnant and then I can make money, that is good, right? So that way it is kind of a hedging also. If I'm only investing in index, but then if there is market remains stagnant and then oscillating within a certain range, right? So then here this makes money. So whatever I told, the 5% and 10% example doesn't need to be that. It can be 2%, 5%, or 1%. I mean, 1% is too much, too volatile, I feel. I mean, too many trades will happen. 2%, 5% can be one combo. 3%, 7%. Any number you can do. You can just select two numbers. I wouldn't say here, please. I wouldn't say that or advise to go through the history or so. Better to keep some random number and then go with it. Okay. So this will also help to a certain extent to reduce the. So let's say if market is stagnant for quite a while, then our opportunity cost was lost also, right? It will stay there only. So here we will make money with that also to a certain extent. So that was the point. Okay, so what should we do? How do we hedge a portfolio? So what is the right hand side? Right hand side is a smooth equity curve in our portfolio. We will need to aim this returns in our portfolio to be as smooth as this. It should not be up and down and up and down. I want a very low beta return. Low beta means what is a beta? Beta is called by how much my portfolio performs compared to the index. So it must be lower than the beta of the index, right? Indices also have some beta. So my portfolio returns must be lower than or the beta. It should be a smooth curve. What we can see here is a smooth curve. It's not like it's going up, down, right? So as you can see here, so in this case, as I was telling, so buying puts was one strategy, and selling calls, that is using covered calls, that was one strategy. Combination of cash secured puts and covered calls. So this is called options wheel. So all these things again is a separate. This F&O hedging itself can be a separate session as such. Maybe I think it might not be needed right now. So maybe later on we could. Okay. So I'm able to hear some echo.
It's clear now.
Yeah, now it's clear. Yeah. Okay. Okay, there is a spreads and combinations of options and futures. This also can be done using spreads, and then what I call it is credit spreads, which I'm doing to a certain extent, and then even futures also. We can do spot future arbitrage kind of trades and things like that. Okay, where some certain percentage of our portfolio will earn or grow at 7% or so, no matter what happens, and the rest of it will 7 or 10% or whatever. It depends on the premium options, premiums, and things like that. And the rest of the portfolio will grow at Nifty index level. Okay, so this is what I would say. Most of the hedge funds, by the way, do this actually. They call it 3:1 covered call hedging and things like that, where the stocks they are bullish with, they do this covered calls. Okay, one portion of covered call with 3% of the portfolio, three or four parts of the portfolio. This helps to ensure that even I'm doing this actually. So this helps to ensure that it's and other hedge is added there, right? So this is what I would say. Gold, investing in gold itself is a hedge, as I was telling earlier, because gold moves up in general when market goes down. There are rare scenarios when both have gone down, market and gold, but I would say gold also to a certain extent is there. But I don't want to go beyond 15-20% there also. Yeah. So what are the risks? There can be over hedging or under hedging. Here I would say it is to the individual and then his or her let's say risk capacity that we will need to think about and then see what suits best or so. I would say this is not easy. It will take time, and then maybe after consideration one can do, or maybe learning from their own way, then they can do, right? So some things are like margin calls, liquidity risk. F&O is, that is why a very risky thing. So we need to be very careful. Okay, we will need to have the rules set, or else sometimes it can be extremely dangerous. F&O can take out money within it. Basically, people get greedy, right? Greedy and fearful, and then it's like an addiction, right? So for some people, I would say, if they know that, I would say it is better to avoid this F&O hedging also. It's okay, even if you don't have that hedging. This hedging is just to ensure that it is there. I mean, we don't have an issue. Maybe they can do with inverse ETFs or some other way of doing it. So I would suggest that F&O is extremely risky, and then stay away with it. It's like cigarette, or maybe addiction of cigarette, or maybe alcohol, right? So that is how dangerous it is. It's just that F&O is not advertised or told like that. Even of course nowadays these brokers and then SEBI rules are there which says that we have to do that. The brokers have to do that. So overall, I would say better to stay away. If people are totally new to it, maybe they can take it slowly, and maybe later on they can think about doing that. And when we talk about considerations, as I was telling, trading costs, what is the simplest, right? Generally the simplest is the best way, or the best type of returns also. And tax implications, this is also important. The tax implications keep changing based on the regulatory requirements, right? So there are a lot of things from the regulation side where there are rules and regulations where things keep changing. So that way even tax implications can change and all those things. So we will have to keep our eyes and ears open to this, and then see what else is there coming from the government, such government and SEBI. So this is what I had. Nothing else to share from my side. Thank you all. Any questions so far? Yeah.
Thank you, Chaitanya sir, for a lovely presentation and letting us know the most simplest things in the most simplest way.
Yeah, thanks, sir. Thank you very much. Well, I'm very glad that you gave me an opportunity to at least present. Thank you very much for that.
So it's all open for anyone who can present, and it would be lovely that um, others also come forward to present. Sir.
Yeah, absolutely.
Deepak
I,
sir, Deepak sir,
I
Yes, madam. Please.
we can make it like a series only, no? If Chaitanya sir doesn't mind
Yeah.
presenting or giving us some time, we'll go portfolio building, diversification. Each session we can take.
Yeah. As he
The
has said,
presentation was lovely.
Thank you. Thanks, ma'am.
I have a question.
Yeah, sure.
One is you said you are working towards the fire movement.
Yes.
Okay. Are you because I joined in late, so maybe I have missed in a part of the presentation. I joined in a little bit late. First of all, congratulations on your fire journey, and hopefully you achieve it soon. So that is one part. On your fire journey, what do you think? How can you actually be sure of what is your fire number, and that gives you, like, even if you have achieved, then you're not sure of that kind of you near fire, and then you've still achieved your corpus and still you're not sure of it. What can be done to actually take that leap of faith and then stop at doing at your normal job, and then you can you have something about
Yeah,
this?
sure. Yeah. This is the, let's say, $1 million question also, and a very good question here. Thank you very much for this. So here, what I would say is, at least this is all more subjective, what people think, and then maybe I could say it can depend upon each person's, let's say, current condition, financial condition, and overall families, even family background as well, and then how they are doing overall, right? So here the point is, some things to consider, some important things to consider here is, so fire movement is one thing where whatever the expenses today that I'm incurring, so how much would I be able to, will my passive income, maybe even if I consider 10% growth, we have to consider always a conservative growth of our portfolio, overall portfolio. Even if I consider 10% growth in my portfolio, what is the, let's say, so let's take an example. Okay, if it is 5 crore, okay, if my overall corpus is 5 crores, and then let's say if the passive portfolio growth is 50 lakhs, of course I will not be withdrawing the whole 50 lakhs here, right? So for the fire movement, so in that case, let's say my yearly expenses is 15 lakhs or so, 15 to 20 lakhs as such. So now what part of it should go to equity, what part of it should go to all other instruments, right? So I was just telling 60 or 70 15 15 or 60 20 20 should also be okay. If someone has retired, it is better to reduce the equity a little bit lesser. So it can be 50 to 60% equity, and then maybe 40% in gold, or 20% in gold, and then 20% in debt also. Because that will be a big question as to what will we do once we, let's say, if we are retiring, if something bad happens, right? So that is one side of it. The expenses might not be exactly the same what we are doing. Our expenses might reduce also, because we might not be traveling so frequently, and we might not be traveling to office, and a lot of daily chores that we do, right? And then, for example, eating out or maybe ordering, all such things might reduce, because we'll have time to do all our daily chores here once we retire, right? So that way, some things might reduce, some things might increase also. That is one side of it. Another side of it is, for fire movement, having a health insurance, having a term insurance, I would say yes or no. It can depend, because if we are already financially independent, term insurance might not make sense. But then I would say it is okay to have some sort of term insurance. And then health insurance becomes extremely important, and have a separate bucket for that health costs, right? Some family emergency, something comes up, keep building that separate bucket. We call it bucket strategy. There are multiple strategies for fire movement alone, okay? This itself is a separate session actually, but yeah, maybe let me tell. So let me summarize it at a short, maybe consolidate it at a short and crisp way. So here multiple things have to be considered. How much does his family overall has, right? The corpus, let's say one person might have 2 crores or 3 crores or whatever. We must think about the whole family, let's say 5 crore corpus or 10 crore corpus. The whole family is there, and the medical emergencies of that family, because the inflation of the medical costs are higher than what market returns gives us. Okay, it might be 14% today, but overall I say that in the long run it might be similar to market returns, let's say 10% or so. The inflation, let's say over the next 15-20 years, it might be 10 to 11% or whatever. Okay, today it is 14%, but then that doesn't mean it will stay at 14. Similarly, when we are going for kids education, that is another thing which is very, very important. Here also it is pretty close to the market. It is growing pretty close to the market rate. Okay, so what we'll need to do, we'll need to invest, maybe have 1 crore or so kept aside, 50 lakhs for child's education and 50 lakhs for medical expenses, or it can be even more, maybe 75 or so. All these things are very subjective and totally depends on individual's case, but then I would say at least 50 to 75 lakhs is the bare minimum to have. That is a separate bucket where we would invest some parts of it to debt, gold, and some parts of it to equity, and another bucket also having similar things, components. One is for child's education, one is for, let's say, medical expenses of ourselves and the parents, right? So these two are the separate things. And then coming to the fire part, so they also say that 4% rule, 3% rule, things like that. Okay, 4% rule is nothing but if I can withdraw 4% every year of my overall corpus. It's the same actually, this, or 3% rule, let me say. So this 3%, if I have, let's say, 10 crore corpus, if I withdraw 30 lakhs, I will never run out of that money. If I withdraw 30 lakhs every year, I will never run out of money, no matter what happens. There are Monte Carlo scenarios, and there are 98% or 99% chances that we will never run out of money. So this is the concept of fire. So I would say that there are a lot of things to consider here, and it is subjective. But then we could just go with some certain corpus or so, and the standard of living we would like to prefer. For example, if someone likes vacations, then they need the base corpus to be higher. Actually, international vacations, if someone has to go, then at least 10 lakhs will go there itself, and we will need to add inflation to that also. So it all depends on multiple things, as I told. Family emergency and kids cost we have to consider no matter what, and other things also we need to consider based on each individual's family situation, and based on that we can come to a fire corpus. Okay, so I would say we can't generalize it. We can generalize to a certain extent, but then specific things we will need to add or remove based on what we feel the expenses are. Sorry for this answer. Yeah.
I just have this thing. I have done a back of the envelope calculation because let us say this is 10 years down the line or something. So, having that figure precisely is not very important. Rather, more important is to achieving that corpus, and achieving a precise figure is not very much important. But then what I came up with, there are two things finally with all my research and whatever, that I needed around 35x as a safe figure for retirement corpus, or let us say fire corpus, or whatever you call this corpus, fire corpus, fat fire, whatever is it. So that would be the corpus required, and 3.5% of withdrawal rate would see me throughout whatever would be the lifespan. So what do you think about these two figures, having a 35x corpus as such? Because I just want to know whether is it conservative enough, or is it too ambitious to be achieved or something like this. Forget achieved, but can a 35x figure last something like a 20 to 30 years of lifespan in post retirement?
So just sure. I understood your question, but then let me put your question this way. So basically 35x or the percentage, whatever we talk about, both are two sides of the same coin. Okay, basically both are similar what we are talking about. So it's not 35x and 3.5% here. So let me put it this way. If it is 3%, so if I'm withdrawing 3% every year, from 100% every year, if I'm withdrawing 3%, so
It
then
becomes 33x.
3.3x. Okay.
Yeah.
So if it is 3.5%, then it will be 28x or somewhere there. It's not 35x. So if it is 35x, then it is 2.8%, something like that. I'm
Yeah.
right with the calculation.
Yeah.
But I understood. Your question was 35x basically, not.
Chaitanya sir, sorry to interrupt you,
Yeah.
but what do you mean by this 35x?
Okay.
It's a very nice question.
That needs another webinar or so, where this fire concept, this bucketing, and then this 35x, 3% or whatever, this itself is a separate topic. But then let me try to explain as much as possible that what I can, because this needs separate slider or so. We'll need to talk about. But maybe Anil, I will try to answer Anil now and try to such that others will also understand. Okay. So now when I say 35x or let's take simple example. Okay. Let me if I have 10 crore corpus, if I'm withdrawing 2% every month, so that means 2% I can withdraw 50 times, right? 10 crore corpus is there, and then I'm withdrawing 2%. So 2% is 20 lakhs. 20 lakhs into 50 times is what makes it 10 crores. This is why we call it 50x. If I'm withdrawing 2% every year in 10 crores, if I'm withdrawing only 20 lakhs every year, so then this is 50x fire corpus. Okay. But on the other hand, when I say 3%, it is 33x fire corpus. This is where the x comes into picture. That means if I have 33 times, 33x is 33 times what I spend in a particular year. What does that mean? If I'm withdrawing 20 lakhs in a year, that means I'm spending 20 lakhs in a year. So if I'm withdrawing, if that spending corpus is 20 lakhs, then 50 times I can withdraw this. So 50 times of my yearly spending corpus should be there for my retirement account. Okay, if I need to retire now, I need to have 50% of it. So if it is 50%, the Monte Carlo analysis says that there's a very high chance that we'll be able to sustain this, and then no matter what happens, if market falls and then it stays stagnant, you know, this, that, all these things, no matter what happens, we'll be able to ensure that our corpus doesn't run out until we are 80 years or 90 years or so. Okay, that is the basic funda behind this. Now coming to Anil's question, he was asking 35x whether it is okay. Okay, if 35x is okay, that means it's around 2.8% or so. I don't know, 100 divided by 35 we have to do. I don't know the actual number. It is less than 3. It should be less than 3. It should be 2.8 or 2.9. So around that range it will be. And then now our corpus would be whether it is enough is what Anil is asking. So again, here we will need to see what are our expenses. And then Monte Carlo analysis says that maybe 80 to 90% of the times it will be fine. Okay. When I say Monte Carlo analysis here, there will be a lot of outcomes done. Okay. Lot of market scenarios outcomes, which is being analyzed by some AI model. And then it will keep trying to find out which is best also. Let's say it will try to see the expected outcome if market stays stagnant, if market goes up, goes down, all such things based on the probability. And this analysis was also not foolproof. Okay, I will not say this is fully perfect. It will do based on the previous market cycles also, and then it tries to find a fully bear market, fully bull market, and it puts the hypothesis based on what is the percentage that you will survive. I think it is around 80 to 90% to answer your question, Anil. So
Thank you very much. Thank you.
Yeah. So 90% completed that you want to do this, or you want
Just,
to run out of
just one you told na hedging. Suppose I got 2 crore portfolio today, and Monday to Monday I want to buy a put. So my 2 crore portfolio, I want to buy a put of December. Suppose 21,000. Now the lot size is 75. The price of 75 multiplied by 300 comes 25,000 Indian rupees, 25,000 rupees for one lot.
Yeah.
So how much amount of put I need to buy to have a protection of 2 crore?
Absolutely. Yeah. I would say here, okay, again, I would say this is a separate as I was telling, this can be a separate session or so.
Yeah, in short,
Separate topic. But then I will
in
answer your question.
yeah,
Hold on. I will answer your question. Totally agree. But then some people might not understand. This is the disclaimer I'm providing. Okay. So what I would say is we will have to treat this as a term insurance policy. So in our term insurance, we put some amount of money and we don't expect anything. In case something happens, we will get this money back, right? So, or even for the vehicle insurance, if we do a vehicle insurance, if vehicle goes stop, if vehicle gets burnt or so, no matter what happens, we will have some sort of corpus. If vehicle goes off, we will get this insured amount, whatever is there, we will get it back, right? So this is the concept behind buying puts. Now I'll come to your question. How much of put should I buy or what should I buy? Okay. At least my style is, there is no one single answer here also. If I say this, then it becomes like timing the market or betting on something. Okay. All this thing again depends on our psychology, individual psychology, to by how much you will be able to tolerate. And then if you are firing, right, if you are financially independent, if you are retiring early, then the problem is you will need to be equipped with these. You should have better shock absorbers in your portfolio overall, right? So that way I would say have some at least 20% below put, whatever is there, maybe December ka put or June's put. Far away put, why I would say is because monthly put will have more theta. Okay, far away put maybe some 20% down the current market price, because what I was telling was 20% fall. If that is covered, it is fine. So overall, my costs have been like 0.3 to 0.5% of my overall portfolio. When I say 18 lakh, future lot size is 18 lakh. So then I buy 0.2 to 0.5% of the size inputs. But that doesn't necessarily mean you have to buy that. You can buy at the money also if you feel that market falls more, and then if you are even more worried, let's say at some point in time. Basically, it ensures that you will have a sound sleep, right? So you don't need to worry about any market uncertainties altogether. So that is like you can think of an expense ratio that you pay, but generally there is a cost. Since we have this fear, this amount of fear, we have this cost. Why do we have this fear? Because we are retired. We don't have any other source of income, right? So that is why we have this fear. So we are paying the term insurance of 0.25%. So if we map it out into real life, real time scenarios, this is how it pans out. And this is what we will need to pay for not earning something. So there is something called, in fire itself, there are multiple things: post fire, barista fire, fat fire, regular fire, all these things. Post fire is like, I retired from my main job, but then I like some hobbies. But luckily, these hobbies also generate some money. I only work 2 to 3 hours a day. And then I'm not telling about myself, but then I'm just telling what is post fire. So the person only works for 2 to 3 hours a day, or maybe some 3 days a week. Still he earns small amount. Maybe his salary was 2 lakhs, but then now his salary is just 30,000. But still that is okay, because his portfolio is already growing passively by maybe another 20 lakhs every year, 30 lakhs every year. That is okay. So he's just sustaining to cover his day-to-day expenses, right? So that is what post fire means. So there are a lot of types of fire. So here to answer, I hope I answered your question now. So whatever you are asking about F&O part, 0.25 to 0.5%. Yeah.
Yeah. Okay. Thank you.
Chaitanya sir, I just wanted to ask you something.
Yeah, sure.
Considering the gold, which is going really high, should we wait for the gold to come down, or should we go on collecting?
Okay. So here
I'm
again,
just asking your personal opinion.
Yeah. So again, there's no single answer. As I was telling, my personal opinion would be not to time anything here as well. Okay. I would say it is better to keep doing SIPs in the same mode, where 50% can be in gold Bs or SGB or whatever, and 15% and the remaining 70% can be in equity. I have been doing that SIPs continuously, and I will continue my SIPs still. I don't want to do.
Pramod here.
Yeah.
Sir, one more, sir. Sorry. Considering the interest rate which is coming down now, what effect is it going to have on the liquid funds and the bonds?
Bond returns will reduce overall in the long run, if the interest rate is coming down, the bond returns will reduce. But we can still think of maybe the arbitrage fund is another way where we will be able to invest and then get close to 6 to 7% still. Okay, but in general, when the interest rate, RBI interest rate has been reducing, then the option premiums will also reduce by that much. If option premiums are reducing by that much, even arbitrage funds returns also. Arbitrage funds are mostly because of the theta in the options, and there will be some kind of theta in futures also. So it is linked to that. So that also would reduce a little bit. So there is no other way. Maybe long-term bonds right now, it is trading at 7%. It gives 7% yield, 6 to 7%. It is there, the yield so far as of today, I would say. Like 2074 bonds we have. Okay, guaranteed 7% returns. Almost every. If I invest 1 lakh, I will be getting 7,000 or 6,000.
Which one is that, sir? Which one is that?
If you see government bonds, GS bonds, you will be able to get. Or maybe we can discuss in the group also. Any of the group.
Sure.
That which is that I was seeing recently also in Zerodha also. Yeah.
That are government sector available on RBI Direct, no?
RBI directly is available, and even in Zerodha it's available. Yeah, via Zerodha we can apply and then we can get it also. I remember anywhere we can buy. Yeah.
This we can buy from primary market, secondary, for any broker. You can buy all G6, long term, 10 years, 20 years, all are available directly from broker also.
Yeah, correct. Based on the liquidity. Yeah.
Chaitanya sir, if you don't mind, I can add one sentence here, if just to create a medical.
Feel free, please go ahead.
Savita madam, you said the gold prices are going up, and what should the investors do? Now,
yes, sir.
Ideally, the investors should have a strategy that they are sticking to the asset allocation. And if you are adding bonds and gold, they are like hedging, as Chaitanya sir said. So you should already have that strategy. Now, it should be immune from what is going on, what prices the gold is going, which direction the equities are going. It's something in medical analog. You have preventive vaccination before. You don't the individual after getting exposure to the pathogenic organism. Only one disease which is effective is rabies. You have vaccination post-exposure in rabies. In other diseases, it's prevention. You have vaccination for the pathogenic things already.
So whatever the prices, we go on buying as per our. What Deepak sir, I wanted to know about this dip buying. Now the markets are sinking, so it's a good time to buy the Nifty 50s. Correct?
No, every time is good buy. A good buy provided you your asset allocation. Like every month, we should all have a strategy that 60% of my thing should go into equity, 15% gold. If we have that, other things can go into bonds. So sticking on to that, and if possible, annually we can rebalance the things to reset the things. So resetting the things to the set things, like 60% equity, 2% bonds, 10% gold. Every year you rebalance it. That is a risk mitigation or risk reduction strategy, which investors endorse. So you have hedging also, and you have risk mitigation also. If both the things go hand in hand, a huge corpus can be built with huge reduction in the risk also.
Okay, got it, sir. Thank you.
Chaitanya, for me.
Sure. Yeah, hi for me. Yeah.
So it was very good session, and I really appreciate for taking your time and providing this session. And yeah, I agree with the term what you told on long-term investment and the FNO part, like hedging, and not to consider it as a trading in FNO as full-time work, as you're targeting, and the short-term gains are going into the short-term taxes for the government. And yeah, it was very good session today, and I hope we have many more sessions. And the other part, like what we were talking on the gold side, as at present I am seeing gold bills are rising, but there are some prices which is mismatching with the actual gold price if we consider it with the foreign golds, whichever it is moving higher side, but gold base it is not connecting to the actual moment of the gold. So AG sovereign gold bond also it is not much over there as it's a fixed income kind of scenario.
Yeah. So you can see, depends on your comfort. At least I would say that gold bees correlation we will need to check now with the price of the gold. Maybe in the last 5 years or so, there was. So it was, for example, if you see gold bees, right? Gold prices rose overall. We know that around 10% or so, right? So overall. So, but if you see gold bees price, it was around 60, 58 or 60. So that has also risen around 15-20%. So even gold prices rose 15-20%. If the rise is similar, right? So prior and after the this thing, maybe we can check the correlation. I haven't checked at the closest level. So that is also
The moment what we feel is whenever there is a war kind of situation, like recently, even UK government told that there is a shortage of gold with them as a reserve, so they were applying for to buy the gold from other countries. And this Chinese government also buying more of the gold, and these people are creating demand, and gold price is shooting up. And other side, Donald Trump attacking on the tariffs and war situations were going on. So all this
Yeah.
impacted gold price to move up. But the actual scenario, what's happening with this AMC, especially who are providing this gold base, every time gold moves upside in a global market, but in the Indian market, I can see a recent case where gold has moved almost $50, but in gold base we have seen minus 1% on next day. So what happened is this AMCs keep on selling their holding or some price mismatch happens. Happened in before 2022 also, which when I feel that when Indian equities are going down or other equities are going down, by default gold is going to go match in that scenario also. So
So
somewhere
here,
if the people are investing in gold, so better to not to blindly believe and enter into gold biz. Yeah, if you have a certain portion of investment where for a kept for a long term, then it's a good plan to go ahead. But short term, sometimes there is a mismatch into gold prices.
yeah. So I mean, what I'm telling is, so here also we will need to check the correlation at least maybe for the last. Let me try. As you were speaking, I was trying to check the correlation from last August, right? Last year, August. What was the correlation of gold? So it was, let me take that number or so. So it was around, I am just taking international gold future prices. So it was around 2,400 or so. Okay. Now the gold future prices last August, I'm just taking, that was the last low what we saw. And
now it
today
is
$2,900. So which is 20% higher, right? So 2,400 to 2,900 is 20% higher compared to last August, what I'm seeing. Yeah, now let's come back to Indian gold piece. Okay, gold piece was 57 rupees. So now it is 72 rupees. Okay, so 57 to 72, it is almost 27% higher. Yeah, gold base is giving much more returns here. There is not exact correlation here. But gold base also, one more thing we need to remember is gold base is traded in INR, but this is traded in USD. So we'll have to account for USD INR appreciation also. If we account for all that, so then this 20% and then the 28% will almost match. Maybe it will come to 24 or 25% because 1 year it is 3 to 4% inflation. So it is 24%. Still, gold bees are giving some 3 to 4% additional returns, but it will average out. Short term, it will be there. Gold bees is giving additional returns, but in the long run, it will be averaging out.
So more or less, in long run, everything fades out. All these
Yes.
Differences will phase out, and it will give almost the same correlation as you said, right?
Yes. That's what I see. At least right now, I
So
just checked this.
the mantra is long term.
Yes. Absolutely.
Because what
And
happens
here
is
also,
there are like small price movement which happens in a day-to-day movement where they keep on adjusting the price. So sometimes there is a mismatch over there. But in a longer term, if you see, it will get adjusted, and it will show the actual return in a longer term.
Yes, yes, exactly. That's why I'm telling longer term is what we'll need to be worried about. Let's say when I say long term investing and these things, so it should be like at least 7 years, okay? So where we don't even worry about it. And one more point is not even gold base. It should also be ICICI gold and different type of golds also. I don't mind actually even to have some part of physical gold, maybe gold coins or so to buy it. But generally, I'm not a fan of physical gold as much. But then it is okay in case some government defaults or so. Those are the worst case scenario, rarest of the rare ones. But still, to a certain extent, we are diversified. So here also, the diversification means that I'm having some in gold Bs, some in gold ETF, some in gold mutual fund, some in maybe gold. Physical gold only at home or maybe in locker. So we are diversified truly in all sorts is what I would say. Definitely there will be lesser returns here because I don't know if we are buying physical gold in the form of jewelry again, it's again a problem because making charges and all will take a lot of money. But at least gold coins, I think it might not. I have maybe we'll need to check. But definitely here also I would say diversify as much.
It's
This is
like
my opinion.
Chaitanya sir, once this war situation and all settles down, I think gold might come down. No? This is, I feel it's because the whole world is panicking and everybody are holding gold.
Yeah.
More than this war, this Chinese governments are they are buying huge gold reserves
How
because their
long they
country
can
has
keep?
been
What will
bad
they do
state.
with that?
Yeah.
Waiting one fine day, they will release the
every
gold and
country's
they'll
forex
bring the
reserves are
market
measured by
outside.
gold.
No,
Yeah.
More the
their country has
gold, the
been
richer the
majorly
country
impacted.
becomes.
So their country
How
is
this deep
majorly
sea came,
impacted
those
because
people
of
will do something else to give shock to everyone.
earlier Chinese government was holding more US bonds. Then when Donald Trump started attacking them, then they
They
shifted
started
from US
dumping all
Treasury.
the, yes.
Yeah, they started dumping US Treasury and they started buying the golds, and they are keeping the reserve. So it vice versa. They play with the US, the second counterparty.
Yeah, that's also true. I mean, there are a lot of short-term things which keep happening, a lot of things that keep changing. Definitely, we can still, if we feel that because of some macroeconomic condition, we feel that something is going to happen in a certain way, then we can at least poise our trades and then give that little bias to our trades. But then, in general, I would say in the long run, it will all iron out, it will all average out. If you're talking about 10, 20 years of timeline, you just keep doing SIPs blindly, forget about everything else is what I would say. But if someone has an edge, right, I don't want to deny them that, let's say, opportunity or so it is better to go ahead with that also. So when I say that, I don't want to brainwash anyone saying that you can't time the market, but then I just put out the facts overall everywhere. If someone has real good conviction in some macroeconomic things or some someone has some insider info in some things, definitely they can go ahead. Or even the past things, if some strategies are working, for example, that would also be really good. By the way, Pramod is really good at algos and he has his own site also, even for the algo parts. So, yeah, thanks for joining in, Pramod. Yeah.
But I appreciate you are being continuously with your algos and your holding from it because we keep on testing several strategies, and now we are running with the this one writing side and then buying side long and right. Before that, I was doing manual testing all those things.
Yeah,
So
yeah.
but you have been continuously in algo side, and I think almost 4 to 5 years.
Yeah, I have also done
You-
algos.
Yeah.
Yeah, yeah. Okay. Oh, you are talking about your right? So yeah, right.
Yeah. No, I mean your traits.
I mean,
You have
huh?
been
Okay, yeah, I have
continuously
also
from
been
point of
there.
view.
Yeah, I have done some algos, especially those grid bots and things like that, but very small corpus, right? So of my portfolio, not percentage wise, it will be very less. So I
No,
was
you
just
are
telling.
saying small. For us, it will be bigger only.
Yeah. Mr. Chaitanya, I sorry to cut you short, but
Yeah,
you've been doing so many things, and do you propose that SIPs or that doing an asset allocation would rather be more helpful than algo trading, crypto trading, and all those, or do you consider all this as a part of an asset allocation plan and do it? How do you do it?
Yeah. So let me come to this. My algo tradings were mostly for that hedging, or so whatever I was telling, right? That in one of the slides I was talking about hedging part, where in case market is too volatile, right? It captures the volatility. This strategy only captures the volatility. There is nothing else at all. And I don't want to time anything here also. It's just capturing the volatility and trying to get some returns or some churning there in case market stays stagnant, which miserably failed because market kept on going up, right? Maybe now it has been a little stagnant.
Maybe you were too early for the trades.
Yeah. And I didn't do
Now
so I don't worry at all about that. It is very small thing. So very small corpus, like 5% of my portfolio or something like that is what I was doing. And there also I tried, initially I was doing STCG. Once they changed the rule of STCG to 20%, I stopped that also. Now I'm only planning for LTCG, and then I don't follow the rules also so obediently. Once in a while I do, and then I ensure that as less as possible the taxation should be. Okay, that is how I'm thinking. Sometimes I also book more taxes, more LTCG, because this 15% or this 12.5%, I don't know how long will it remain. Okay, one day it will be 15, maybe over the next few years, and someday it may be 20 also. Now we have the opportunity for 12.5. Let us convert as much as of our profits into non-taxable amount for this 12.5%.
Where are you based, Mr. Chaitanya? Where are you based? Bangalore. Okay. No, for some NRIs are lucky; they can get away with this LTCG. Some certain DTA. Yeah, DTA. They have DTA, so they can do it.
Yeah. Nice.
No. Chaitanya sir, what's your profession?
I am into R&D, software R&D.
Okay.
Yeah, I lead a team, so I'm a manager.
Priya madam,
Mr. Chaitanya.
I have a question here.
Yeah, Mr. Chaitanya, actually I joined quite late. So would it be possible to share the presentation with us?
Sure, definitely.
We have the recording. I'll just upload it in the YouTube.
Okay. What is the YouTube channel? Please share the link also in comments, please.
I'll share it. Sure.
Yeah.
Hi, Chaitanya. Am I audible? Rishank Pandey here.
Hi, Rishank. Yeah, you're audible.
Yeah, hi, Chaitanya. I'm sorry I joined late, and I know you for I think almost around 5-6 years, and the passion you carry and the knowledge you have, that is fantabulous, man. I would say that I'm like 41, and I'm been into the market for around 7-8 years, and I learned a lot of things from you. So thanks for that.
Yeah. Thanks.
And few things I wanted to mention here, as we have been discussing for a long time. And both of us agreed that long term wealth creation is the primary thing. And I feel I'll put my perspective here, and I request your feedback also.
Definitely.
I think So I think whatever the system we are following, whatever the strategy we are following, it has to be consistently followed for a long period of time. It shouldn't be like I am following a particular thing, 52-week high stocks or something like that. After 2 or 3 months, if that strategy is giving me good benefit, then it's okay. And once it starts obviously the market cycle, as everybody knows, it keeps on changing. So
yes.
Today, if one particular strategy is profitable, it doesn't mean that it will always be a profitable. There will be time when I may incur some loss, but in any case, I mean, I should follow the process consistently, and then only we would be able to see the result in long term. But
Absolutely,
human
absolutely.
psychology, sometimes most of the people, sometimes I also do, that this strategy is not following, so this ये बेकार है, strategy अच्छी नहीं है, let's get back to the other strategy, which should not be the case. I mean,
Yeah, yeah.
so
I
I think
totally agree with
consistency is the main, important thing.
you. Yes.
So that's it. I mean, there are a lot of strategies, and one should master on one, two, or three strategies only, and just follow the process, like just like machine. No emotions, nothing.
Yeah.
Then only I think we would be able to create wealth for long term.
See, what I would say is that chasing the strategies, okay, it might work for some people. At least for me,
Right.
I've been fine-tuning my existing strategies only. That's what I would say from my experience. Maybe even I might have done without my knowledge, maybe something which I'm chasing, but at least I have tried to fine-tune and make as much as possible to diversify my strategies. Okay, to
Right.
might be over diversification in someone else's lens, but at least I don't know, from whatever I feel.
Yeah, absolutely.
There's
Yeah.
nothing right or wrong. It's all
Right,
subjective.
absolutely. Few months ago, Chaitanya, if you remember, I mean, myself, I was discussing this thing with you that I have been diversified to a lot of stocks, but people say on YouTube and all that only 10 or 20 stocks you should own. I don't think that is true. It depends upon person to person, how you are managing, what is your risk management. Okay,
Yeah, true.
that is more important, and obviously, how you are executing these strategies.
Yes.
And obviously, as I mentioned, I'm repeating again, consistency for long term, keeping your objective for long term. That is the only thing.
Yes.
Rest, all things are subjective. Some people say they just only follow 10 or 20 stocks. Some says that okay, 30 is also okay. Um, for my case, I mean that is little different. Um, so I sometimes I own more than 100 stocks also. But the idea is to manage the risk and follow the process only. That's it. I mean, um, any feedback from
Yeah,
anyone
yeah.
or
So I would say
from
there
your
is one
side?
more
Yeah,
concept can be sure, Shank. Thanks a lot for that. The core concept
yeah,
can be similar, can be on diversification also, and maybe some fine tuning can still be done. But the core concept we should not keep changing as much. As much as possible, we have to stick to that concept, what we are comfortable with, and then just go for the long term. I would say simply, if we don't want to use any strategies, nothing at all, just invest in index fund and forget about it. That's it. I mean, Nifty 50 index fund, I would say, forget about it. In general, it has given returns. Here also, I won't say that. I don't want to say that it will always be that it will give more returns, but at least in general, it has given so far. So, and maybe hedging with gold and some of debt funds, right? So all these things, mix of these, will definitely help us to achieve this 10% goal in the long run. But there is no guarantee, as I
right,
say. Yeah.
Rishank,
absolutely true.
Rishank, I would just have a small comment for you. I don't know how you do it, but then if you say you
Yeah.
have 100 stocks in a portfolio, how do you track them? In if I was to give a geometric analogy, that a single investment is a point. Okay. Now, when you do across a series of time, you get a line or a wave or something. You get a complex. Get a complex pattern. Now, do this complex patterns and you multiply it by 100, you get a very complex plane. How are you going to track this into a long-term journey? So, from a point, you have gone into a line which is a complex curve. It's not a line; it's a complex curve. And then again, that you have done it is that you have hundreds of stocks, as you said. So again, that increases a third level of complexity, and again you do it over a period of time. So I am really amazed that you do this, and if you've been doing it successfully, beating the indices, it is really amazing. But I think it must be taking too much of monitoring from you if you have been really doing it. Most of the big investors, they have a single-minded focus onto a selected selected piece of stocks or selected number of stocks. So if you do it too much, then you might as well hold the index itself, right?
Yeah. So if this question is to me, then or is it to Vishal? Yeah.
It was for me. So yeah, I have few points here.
Yeah.
As you so as you mentioned that it has become complex. That is true, but as long as you are following your principle, and on a daily basis, I track market on after market hours. Because I am also a working professional. I don't have time to look for the market during the office hours. After market hours, like 7 o'clock or 8 o'clock, I generally devote around approximately an hour to the market, and I place after market orders. I think second point is, it doesn't matter you are owning the 100 stock. The concentration on few stocks are more, like more than 70-80% of my capital is deployed only on 20 to 30 stocks. Rest is like some pattern is not is getting materialized, and those stocks are on the verge of hitting the stop loss. That's why they are just lying on my portfolio. uh, as I mentioned that uh, my strategies or what I follow is completely mechanical kind of thing only. Although I track manually, as I mentioned, after market orders I am placing. Um, but as I mentioned, only 70-80% of the capital is deployed with 20-30 stocks only, and rest is like, okay, if they will cross a particular level, then only I will keep on adding. Otherwise, they will hit the stop loss and I'll be out. So I have been doing it for 3-4 years, and it is quite okay, beating the index. Right now, obviously, I mean, market is down, so I'm also down, but it's okay. I'm not as down as as the market. So it's okay. I mean, and if you talk about all the successful investors, they have made huge wealth on few stocks, but I'm sure they would have invested more than thousands of stocks in their
Yeah,
entire
sure.
careers.
So that is there. But see,
Yeah.
what it amounts to is having too much of complexity, because as time grows, physically and mentally we are not as capable as we are today. Tomorrow we will not be there as capable. So one thing is that over a long period, when you look at a long term investing strategy, it has to be sustainable. Consider yourself well into retirement. Will you be able to monitor so many stocks? You will have to think about it. Say 10 years into retirement, you're already there, and you have that. Most probably you'll be tired of handling all these stocks, and you'll one fine day you might just say, let me cut it down and put it into something which is more convenient for me. So think of it even from that point of that, you cannot, you're young now, so it is very different. But as you age, you may not be able to give so much of time and resources to your strategy. So there is a trade-off between getting returns and putting amount, and how much amount of time you can invest into it. So what I felt is that you are spread very thin. Like if it is 100, and I just wanted to point out, it is none of like it would be that Pareto's principle, that your 20% of your stocks would be taking around 80% of your time, if I'm not mistaken, and that 80% of your stocks are taking 20% of your time. And if you cut down your 20%, you might be able to reduce your this one But again, it depends at how big is your 80% and what you want to do with it. I'm just pointing out it is, I'm not, grading you or something. It's just that many times, it's just an impartial, this thing. It is not grading you on any performance or anything. It is just that we are trying to help each other out and I might see something as an impassioned person with my age and experience. I see that, yes, that, spending too much time and this is suboptimal. Rather, you can do something much better with your own time rather than spending it in front of a screen or something else. Everybody has their own opinion. So this was just mine. I don't.
Even coming on the same point, I will also tell, see, the investing part done with proper care. Suppose I got 20 stock and 100 stocks. See, you are buying the stock. How you are buying? Are you seeing the con calls? Are you monitoring the result? Keeping 100 stock, it is a FOMO. I want to buy this also, that also. It doesn't help at all. See, how you monitor the stock, how you buy, what is your strategy? Okay, there is different thing. You keep on buying and you must be earning. You yourself told that 70 to 80% of amount is in the only few stocks. Then what is doing the 80 number of stocks? Suppose 80 number of stocks become 3 times. How much portfolio percentage gain one will get? So think on that point. So I don't think keeping 100 stocks, 200 stocks, 80 stocks, it matters at all. 20, 25, 30, okay, 40, 50 is also a huge amount. People keep 300 stocks in their portfolio. I've seen many people, but you ask them how much amount they invest, they say 10,000 rupees, 15,000 rupees, 8,000 rupees, 30,000 rupees. What it will do? You should have a stock with a proper diversification across various sectors with substantial amount, so that when you get the returns on that, it should be substantial to the portfolio over the time and the money which is spent on the process. So if you are keeping 100 or I'm keeping 100, 200, better to take the various mutual funds. Take 10 mutual funds. Take the various mutual funds.
No,
it will be the
no,
all 500.
okay.
There is a total market index. One very good mutual fund coming up now by Angel One. Total market index. It contains 750 stocks. It is NFO going on. You rather take that one. Simple. Follow that. And peace of the mind. Put 3 lakhs in 3 lakhs SIP per month in that stock. Finish it off. Why we want so much things? We are not a full time.
My perspective here. One second. Yeah. I think maybe Rishank has his perspective. Anil and Pankaj, all of us have a very good discussion here on this topic. Let me put my 2 cents here. Okay. So first thing is the psychology again matters here. Some people might have an itch to, let's say, buy some stocks.
Yeah, that is very true. Even I have that itch. So a smaller portion.
Yeah. Put some small amount until they have 80% of their portfolio in some 15, 20 stocks or 30 stocks or whatever. If it is able to take out that itch, right? If not, if they had that itch and if they are investing that whole money into that stock, then it's a problem. So this is psychology way. Maybe I would say this is still okay if it helps them. Instead of in mutual fund, it will be totally they'll be blinded by that. It's just a fund. Maybe the constituents are the same, but human psychology doesn't work that way. So if it is helping to at least take out that itch, then it is okay. I mean, if it is some 10 to 20% of the portfolio, even if the returns aren't pretty big, if it is very small, for someone maybe with a 1 crore portfolio, some 20 lakhs is in these stocks, and then maybe each one is 1 lakh or whatever. So that 1 lakh, if it becomes 2 lakhs also, that happiness, whatever they get, if it is they're getting it, it is okay. I mean, if it is not affecting anything at all. Their main portfolio is still there, and then if they are not, if their core belief is still there, then it is fine. But with mutual fund, they might go blinded by that. They won't know at all. And even these 100 stocks or whatever, if they are doing only in this top index funds or so, let's say Nifty 100 or whatever, Nifty 50 and Nifty next 50, things like that, then still it is kind of okay because it is kind of safe, but there is no guarantee. Any stock can become zero. That's my point at least. At least in my case, most of it is an index. So that's why I've been doing an index fund. But if there is an itch, it is still okay. I had a big portfolio, but then very small thing, very small percentage of some old stocks are there. I'm slowly exiting one by one, but it is okay. Everyone learns from that. And then if that itch doesn't go at all, it is okay. It's like that. That's what I was telling. Having junk food someday is still okay. Maybe once in a while. It might not affect fully or so. Maybe once in a while, some function you go, you'll have to eat some sweets or things like that, right? So that is what I would say. Instead of avoiding everything altogether, one day we will be like, if you are avoiding everything, one day it will be that we'll take huge risk. Maybe we'll do F&O trading with 30 lots with small margin and then lose it all, right? Because we would have controlled ourselves so much. So this is my 2 cents, but then there is nothing right or wrong. Maybe you guys can also debate on that. Yeah.
Yeah, thanks, Ravi. Just my small point here. So two gentlemen, they mention this thing that, I own 70-80% in only 20-30 stocks, but no one has asked how I have chosen those stocks. So that is what, what I'm doing is I am pyramiding on the momentum stocks. So there are various stocks which are not on that radar. They are not on the momentum. So that is why they are into. I'm just holding it few quantities. That is how this the overall portfolio has grown up. But it's okay as long as I'm able to manage my risk, and as long as I'm able to get out of the stock with small stop loss. I think that is okay. One thing is also true. Yes, at the age of 40, I think I'm managing it. I can manage for next 10-15 years also. Um, by the time, next 10-15 years, if there would be new technology, new AI will come, so that, everything can be done on the basis of, some AI and all. So that will reduce my time and all. So it's okay. I mean, as I mentioned earlier, if you are enjoying what you are doing and you are earning, better than the market, then everything is okay. It depends upon you, your strategy, your style, how you are managing it. That's it.
Rishank, basically, we wish you luck. Oh, only thing is that we don't. I'm not saying that it is. There is no perfect way to invest, but only thing is that over time you might feel that it will take. Traders have a toll. They just burn out because it takes too much of effort in the long run. So just look into that, and maybe you can just it's not that it's something which is not you have found your own method in all this craziness of investing. So perfectly, it might be perfect for you, and actually I wish you success, that you do it, and you get your whatever goals that you want to achieve. There's nothing wrong about it, but only thing is as we grow, as you rightly understood, that as we grow, we don't want to be expending more physical and mental effort. You rather want to you want to make things easier on you. So just look at that point, and yes, enjoy it, and wishing you all the success. Maybe you'll make better returns than the most of us, and hopefully you're rewarded and with your commensurate effort. So all the best, and wishing you lots and lots of luck in your investing. Thank you.
One thing I would like to add that this presentation, hats off to the presentation, the entire session, the discussion, everything. It was a full 2 hours, lot of things to learn. Thanks, Deepak sir. Actually, double thanks to Deepak sir because I was sleeping when Deepak sir called me कि उठ जा भैया join करो. And Chaitanya sir, it was a fantabulous presentation. Lot to learn from you, and excellent discussions by all the members. Anil sir, you are again awesome.
No, thank you
I
very
learn.
much. We are always a part of a community, and Deepak sir, thanks to Deepak sir that he brings gems, and I get to ask, and he gets to, and I get to ask good questions, so everybody learns. Thank you very much, everybody. Thank you.
Yeah, I would also thank Deepak sir. Thanks a lot for providing this opportunity.
Chaitanya sir, we are really grateful to you, sir. As Savita madam requested, we need to have some series continuity on these things, sir. We do not
Deepak sir, really, if Chaitanya sir is okay to give us his time,
yes.
We'll make it like a series. Series ka we'll make a discussion. We'll start.
We could have something else in between also, and then later on, maybe once in a while.
Lovely, nice sir. Karenge sir. You give us your time, we will
Sure.
schedule.
Chaitanya sir, whenever
Thank you so much.
please,
Sir.
in between, if whenever you are free, we can have an extra session. Anything, sir. Even if
Chaitanya sir, whenever he feels like talking about any topic, let him tell us. We'll keep that Saturday.
Thanks, ma'am. But I'm not a expert and all, and whatever I'm doing, I'm
No,
just
it doesn't matter, sir. You're able to tell us what is there in your mind, like clearly. So that will give others a little more clarity. So
Absolutely.
that's what's also more important.
Yeah, my last 18 years journey or something like that, I'm just trying to.
Yeah, very well put by Savita ma'am.
Yeah.
Majority of us, we need to know what not to do.
I would request your presentations too whenever you are free.
Sorry, sir. What was yours?
Whenever you all are free, Anil sir, Manoj sir.
Yeah, everyone else, maybe it is good to.
Sir, मुझे कोई topic अगर ढूंढना पड़ेगा, मैं if I find a topic, I'll give you a presentation, sir. No problem.
Anything you would want to share.
Let me see if I find something interesting. I'll put up something, a small topic, and then we'll talk about it. Thank you very much, Deepak. Thank you very much, doctor.
दीपक सर, एक क्वेश्चन था.
हाँ सर.
आप हमेशा जेंट्स लोग को क्यों बोलते हैं? लेडीज कोई नहीं आती कोई भी कभी भी प्रेजेंटेशन देने के लिए?
टोपा को मैं पीछे लगा हूँ, हाथ में आती नहीं है. क्या करूं? सविता मैडम को,
प्रिया मैम है या सविता मैम है,
बोला है मैंने, उनको भी बोला है, रिक्वेस्ट किया है.
चैतन्य सर, एक चीज बताइए, ये जो अपना एक सर थे जिनके पास 150 स्टॉक्स थे, मेरा भी सिचुएशन कुछ ऐसा ही था अभी तक, बट इस फॉल में मेरा तो हाल खराब हो गया. अब मैं लॉस में बुक करे जा रहा हूँ. MTF में मैंने लेके रखा था बहुत सारा स्टॉक, and I had to book decent amount of losses, and still I am under quite a big loss. What should I do now?
Do you have an opportunity to do tax loss harvesting?
That I've done almost for 5-6 lakh. I already done, but my losses are to the tune of 15 lakhs now.
So anyway, you can carry forward this loss for the next few years. And if you are planning to do, I mean, in general, what you could do, okay, one more strategy that generally might or might not help is when markets fall a lot, right? So then this small caps become more attractive. So your 15%, let's say I invest only in index, okay? Nifty 50 index, 70%, and mid cap 15%, small cap 15%. When markets fall a lot, and I am not retired yet, so in this case, if I have extra money, so what I can do is small cap and mid cap allocation. Let's say if market has crashed 50%, mid cap and small cap would have crashed 70%. Let's say.
Correct.
Just give me an example, 70 or 75%. In that case, that becomes more attractive. Okay. So what I would do, I would change this 70, 15, 15 to maybe 60, 20, 20 or something like that. I mean, ideally we should not do, but if it is lucrative, ideally what happens is that 70, 15, 15 becomes 80, 10, 10 actually, because market fell, right? So you can buy more mid cap and small cap, exit some index funds, sorry, 50 large caps, and then buy mid cap and one. That is what we would do. I don't know what is the right time. This might not be the right time. We can do it in a staggered way. We can form our own rules. I'm just telling that. That is one way. But then now, since you have exited all, if you want to do index, better to do Nifty 50 index. It is still okay. And the same.
Then go for small cap index, sir, 50. Small cap 50 index, best.
When I say small and mid caps, it is always index. Okay.
Sir. Okay. So small cap 50 is better or 250 is better?
Even here, it is okay to diversify based on our so here also it becomes wrong if we are trying to find what was better from the past, right? So maybe have 50-50 there also. So like some parts, but eventually you should be aware of the fact that if you do too much diversification.
लेकिन रात को पक्का ना, कल मेरा ट्रेनिंग है, ये हालत पूरा, इस फॉर्म का हालत पूरा खराब मिलेगा कल, इसलिए आज ठीक कर देना, कल हम पूरा खराब हो जाएगा, कल रात को पक्का था.
So basically what I'm telling is, if we diversify there also it is okay, but then that comes with the fact that there might be headaches in managing it. But since it is index fund, since we buy blindly and we are not managing too much, then it is okay. I remember in Ravi Handa's podcast, he was telling it's difficult to manage the let's say if he has 15 crore portfolio, okay, in 15 crore portfolio, even a 5% move here and there when he is trying to manage this 5% small cap to mid cap or something like that. I don't know what he mentions. So he also tries to do this bucket strategy and things like that. So there it's very difficult to at least move this 1 or 2 crores or something. He says his hand shivers literally. So that's what happens for us. But anyway, when we are in smaller portfolio, it's easy to churn and then do this rebalancing. But in the larger portfolio also, we'll need to think about percentage and then rebalance it accordingly. 70, 15, 15 is what we can keep it in mind. And then if it increases or decreases, whatever happens, we can just adhere back to that. 70 equity, sorry, large cap, 70 mid cap and small cap. 15 mid and 15 small. I'm just telling this number, but then one can go with their comfort level. It could be 60, 20, 20 also. But generally, bulk should be equity.
But only one doubt, like, the way this market has been falling, one fears that we might not go in a scenario like Japan, that it extends till 25 years and I, retire and still my, holdings continue to, go down.
Yeah. So that is also there. I mean, we never know. That is where I was talking about the hedge strategies. But India in general is the probability is less. But then we can't rule it out. It can happen anywhere and everywhere. This is where I was talking about the other hedge strategies, right? Wherein we are churning money no matter what, even if it is idle, market is idle. I forgot to add one more point in that slide. There is arbitrage strategies also, which we can do with our own F&O knowledge, but it is not lucrative. Hardly 7 to 10% is what we get. But then all these strategies put together, right, it will kind of hedge our portfolio in case market is fully stagnant. So that's why we are adding gold also there. So if gold can go up, so maybe even equity. But then Japan, if you see that, Japanese yen the inflation was minus 0.3%, minus 0.2%, like that for the last 30 years or whatever. In many years, it was minus 0.3%, 0.5%, or maybe 1% like that. Okay. If the currency is staying strong, right, then it is okay. Then it is actually better. If you see JPY INR also, it doubled actually. It was 34 or something, 0.34 or something. It became 0.74 or 0.8 within some days. And then now it is 0.6 or somewhere around that range. So that means JPY INR was getting strengthened. So inflation was also reducing. So there was deflation there. So all those we'll need to keep in mind. And Japan had a huge, massive bull run from in the 1970s. So that was also one more factor. Yeah. That's why it stayed stagnant for a long time. So all these factors matter, but we can't rule out for India also. I mean, very less chance, but it can happen. That is where the other things kick in, where we diversify everything. Right? The covered calls, cash secured puts also will churn more money. Covered calls, cash secured puts is basically delta neutral strategy where it churns some money. Okay. I know I am over diversified. Maybe I sound like that, but this is why I try to protect my portfolio. It's okay to lose out on something. Maybe I might not get 12% returns. Even if I get 10% returns, I'm fine with it. But I need it for next 20 years. That is what.
Correct. See, I missed out on your content today because I joined late. So maybe the YouTube channel, if you could mention which one is it, we will join that and gain the.
Deepak sir will share that. Anyway, I had one YouTube channel, but then that I have not been posting much. I had long back I posted something. Maybe I will try to post that. But then Deepak sir is anyway posting regularly.
You're in the DIY. Hello. Priya,
okay, Deepak sir, actually, I will need to leave now. Yeah. Thanks a lot, everyone.
I'll post a link in the group, sir. That YouTube, sir.
Sure.
Thank you, Chaitanya sir. Please, more.
Thank you, Chaitanya sir. Thanks a ton.
Deepak sir, kindly add me to the group also because I'm not maybe in the group. I've given my number in the comments.
In the comments, okay. I'll just add it in a while. Just.
Yeah, I'll be grateful. Thank you.
I'll do that, sir.
Okay. Thank you.
Thank you, everyone. Thank you.